There's a question that's been quietly building in the background of global finance for the last 5 years, and it's the question that will define the next decade of wealth and power. Which breaks first, the dollar system or gold's relationship to the dollar? This isn't academic. This isn't theoretical. This is the actual fault line that's going to determine whether the next 10 years look like the 1980s, the 2000s, or the 1970s. And right now, both systems are under maximum stress. Both are showing cracks, and one of them is going to fail first. When it does, everything reprices. I need to explain what's actually happening here, because the mainstream financial media doesn't talk about this clearly. They talk about gold as a hedge. They talk about the dollar as strong or weak, but they don't talk about the actual structural problem that's building. Here it is simply. The entire modern global financial system is built on the assumption that the US dollar is as good as gold. Better than gold, actually, because gold doesn't pay interest. Dollars do. So if you're a country or a central bank, why hold gold when you can hold dollars and earn a return? This assumption is held for 50 years. Since 1973, when Nixon ended the gold standard. The US government said, "We're not backing the dollar with gold anymore. We're backing it with the full faith and credit of the United States government." And the world said, "Okay, that works, because the US is powerful, and the US economy is huge, and US debt is safe." So the world held dollars, trillions of them. Central banks held dollars, corporations held dollars, individuals held dollars. Everything was denominated in dollars. Trade happened in dollars, loans happened in dollars, savings happened in dollars. This created a monetary system where the dollar was essentially the global reserve currency, backed by nothing except the credibility of the United States. And that credibility lasted. It lasted through Vietnam. It lasted through Watergate. It lasted through the 1970s stagflation. It lasted through the Cold War. It lasted through 2008. It lasted through everything. But right now it's breaking. And here's why. The credibility of the United States is eroding. Not militarily. Militarily, the US is still dominant. But economically and politically, credibility is eroding fast. The US government is spending more than it takes in, by a lot, every year. The debt is growing. The interest on the debt is growing, and there's no serious plan to address it. The federal deficit is running $300 billion a month. $300 billion. Every month. That's $3.6 trillion a year in deficits. And the government is borrowing that money, issuing treasuries. And those treasuries have to be bought by someone. For 30 years, this worked because foreign central banks and foreign investors wanted dollars. They wanted US debt, because it was safe and it paid a return. But that's changing. Central banks are dumping dollars. They're buying gold instead. They're diversifying away from dollar reserves. This is the signal. This is the crack in the system. China has been accumulating gold for 20 years. India is doing the same. Russia has been dumping dollars for a decade. The ECB is positioning itself to reduce dollar dependence. Even Saudi Arabia, the US's closest ally in the Middle East, is accepting yuan payments for oil instead of only dollars. Why? Because they see what's coming. They see that the US is spending unsustainably. They see that US debt is growing faster than US GDP. They see that eventually the US will either have to default, devalue the currency, or inflate away the debt. None of those outcomes are good for dollar holders. So they're moving to gold. Gold doesn't require you to believe in a government. Gold doesn't require you to believe in a currency. Gold is just gold. It's been valuable for 5,000 years. It doesn't depend on policy or credibility or economic growth. It's just there. This is a massive shift in global capital flows, and it's accelerating. Central bank gold purchases are at record levels, not because they suddenly love gold, but because they're losing confidence in the dollar system. Now here's where it gets interesting. The dollar isn't actually breaking yet. The dollar is still the global reserve currency. The dollar is still used for 90% of international trade. The dollar is still strong relative to other currencies. The dollar system is still functioning. But it's functioning under strain, and strain that's visible to the sophisticated players. And when sophisticated players see strain, they start repositioning. They start moving out of dollars and into things that aren't denominated in dollars. Like gold. When you have central banks moving into gold and out of dollars, when you have countries creating alternative payment systems to avoid dollars, when you have serious people talking about de-dollarization, that's a signal that confidence is eroding. Even if the system is still working today. And here's the thing about confidence in currency. It's fragile. It can seem solid for decades, and then it can evaporate in months. Once the perception shifts from the dollar is safe to the dollar might not be safe, the flow reverses. Instead of central banks buying dollars, they start selling. Instead of holding dollar reserves, they dump them. Instead of pricing things in dollars, they price things in other things. When that shift happens, the dollar breaks. Not because the fundamentals suddenly changed, but because the confidence changed. And with currency, confidence is everything. So the question becomes, what breaks first? Does the dollar break? Does the alternative system break? Or do they find a new equilibrium? Here's where gold comes in. Gold is the canary in the coal mine for this shift, because gold's price is denominated in dollars. When people lose confidence in the dollar, they buy gold. So the gold price goes up relative to the dollar. The dollar weakens relative to gold. Right now, we're in the early stages of that move. Gold has doubled from the 2015 lows. It's near all-time highs. And the ratio of gold to the stock market is at levels not seen since 1980. That ratio means that gold is relatively cheaper than stocks, which means sophisticated investors are moving to gold as a hedge against what they expect to happen. But it gets more interesting, because if the dollar breaks, gold doesn't break. Gold just reprices. In a world where the dollar is no longer the global reserve currency, gold becomes more valuable because it's the alternative. It's the asset that works when currencies fail. So the breaking point isn't whether gold or the dollar breaks, it's which one breaks first and what happens in between. Let me lay out the scenarios. Scenario 1. The dollar breaks first. This happens if the US government loses control of its fiscal situation, if the debt spiral becomes unsustainable, if interest rates spike, if foreign investors stop buying treasuries, if capital flees the US. In this scenario, the dollar value collapses relative to gold and commodities and other assets. You get currency crisis. You get capital controls possibly. You get inflation. Gold soars. Real wealth denominated in gold increases dramatically. Real wealth denominated in dollars decreases. Scenario 2. Gold breaks first. This would require some sort of shock that makes gold less valuable. Maybe a new source of gold is discovered. Maybe gold's monetary role is reduced by some new technology. Maybe there's a panic that forces gold sales. In this scenario, the dollar holds. Dollar-denominated assets hold. The repricing is delayed. But this scenario is very unlikely because gold's supply is constrained and its monetary role is increasing, not decreasing. Scenario 3. They break at the same time. This happens if there's a systemic crisis that breaks both the dollar system and the gold market simultaneously. A geopolitical shock, a financial crisis, a pandemic. In this scenario, everything reprices. Dollars, gold, stocks, bonds, real estate, everything. You get volatility across all asset classes. Winners and losers emerge based on who's positioned where. Scenario 4. They find a new equilibrium. The US government gets its fiscal house in order. Confidence in the dollar stabilizes. Gold maintains its role as a monetary hedge. The system continues, but with some adjustments. Interest rates are higher, inflation is higher, but the dollar remains the global reserve currency. This is the outcome the Fed is hoping for, but it requires changes that seem politically very difficult right now. The most likely scenario, in my opinion, is a combination of 1 and 3. The dollar system doesn't completely break, but it undergoes a crisis, a repricing event. During that event, gold spikes. Capital flows into gold. Alternative systems are tested. Some break, some hold. And when equilibrium is reestablished, we're in a different world. The dollar is still the primary reserve currency, but it's less dominant. Gold is more important. Other currencies have more role. And the world is multipolar instead of unipolar. This isn't doomsday. This isn't currency collapse. This is adjustment. This is rebalancing. But for people holding the wrong positions, it's devastating. For people holding the right positions, it's an incredible opportunity. Here's what's actually driving this. The structural economics of the global system are changing. The US can no longer sustain the role it played from 1980 to 2020. The debt is too high. The deficits are too large. The fiscal burden is too great. The US has 3 choices. 1. Reduce spending. Dramatically. This is politically almost impossible. 2. Raise taxes. Dramatically. Also politically very difficult. 3. Inflate away the debt. Print money. This is the path of least resistance. And this is what's happening. When you print money to service debt, you're essentially taking wealth from everyone holding that currency and transferring it to everyone who holds real assets or foreign currency or gold. You're devaluing the dollar. Now the Fed knows this. They're not stupid. They understand that if they print too much, they lose the reserve currency status. So they're trying to walk a line. Print enough to make the debt manageable, but not so much that they destroy the currency. But that line is getting narrower, because the debt is growing faster than the economy can grow. So printing more is inevitable. And when more printing happens, dollar value erodes. And when dollar value erodes, people move to gold. This is the dynamic that's building right now. It's slow, it's measured, it's not dramatic yet, but it's relentless. Central banks adding gold every quarter, sovereign wealth funds repositioning, large investors hedging, all of it pointing in the same direction. Confidence in the dollar is eroding. People are moving to gold. Now here's the crucial part. This doesn't mean the dollar is going to zero. It doesn't mean we're heading for a complete currency collapse. That's not what I'm saying. The dollar will probably remain the primary global reserve currency for decades, but its dominance is eroding. Its role is shrinking. Its premium relative to other currencies is compressing. In other words, the dollar is repricing downward relative to hard assets like gold. When that repricing is complete, the new world will look different. The dollar will be worth less in real terms. Gold will be worth more. Countries that own gold will be wealthier. Countries that depend on dollar reserves will have lost wealth. The distribution of global purchasing power will have shifted. This is a massive intergenerational transfer of wealth, from dollar holders to gold holders, from people who trusted the system to people who hedged against it. And the timeline is accelerating. 5 years ago, I was saying this would happen over decades. 3 years ago, I said it would happen over a decade. Now I'm saying it could happen in 5 to 7 years. The acceleration is because the deficits are growing faster than expected. The debt is growing faster than expected. The Fed's policy responses are more dramatic than expected. Everything is accelerating. So we're in a window right now, a window where you can still reposition, where you can still move from dollar-heavy positions to gold-heavy positions, where you can still understand what's coming and adjust your portfolio accordingly. In 2 years, this will be obvious to everyone. Asset prices will have adjusted. The repricing will be partially done. In 5 years, it will be complete. The new world will be established. And if you haven't repositioned by then, you'll be stuck holding depreciating assets. This is why gold is important right now. Not because it's going to the moon, not because it's a get-rich-quick scheme, but because it's the insurance policy on the dollar system. It's the asset that preserves wealth when currency confidence erodes. Now, I need to be very clear about something. I'm not saying sell everything and buy gold bars. That's not smart. Gold doesn't produce cash flow. Gold doesn't have earnings. Gold is pure monetary asset. You buy it for preservation, not for growth. But as part of a diversified portfolio, as a hedge against currency devaluation, as insurance on the system breaking, gold makes sense right now. Especially if you have most of your assets in dollars and dollar-denominated investments. A reasonable allocation might be 10 to 20% in gold or gold-related investments. Enough to hedge against a significant repricing of the dollar, but not so much that you're sacrificing growth and returns. The point is to be aware, to understand what's happening, to position yourself ahead of the repricing instead of getting caught in it, because the repricing is coming. Dollar versus gold. This is the battle that determines the next decade, and it's just getting started. Here's what you need to watch. Federal budget deficits. If they're growing, that's a signal of dollar stress. Interest rates on treasuries. If they spike, that's a signal that foreign buyers are demanding higher returns to hold dollars. Central bank gold purchases. If they accelerate, that's a signal of losing confidence. The gold price. If it's rising while real interest rates are high, that's a signal of increased demand for dollar insurance. All of these signals are positive right now. All of them are pointing toward an eventual repricing of gold relative to the dollar. This isn't certain. Politics could change. Policy could change. The fiscal situation could be addressed. But based on current trajectory, the probability of significant repricing is high. So position yourself. Be aware. Understand what's actually happening beneath the headlines. And if you want deep analysis on this, if you want to understand the monetary system at a level that actually matters, if you want to see the signals before they become obvious, then you need to be following this channel. We break down the structural economics of currency, gold, and the global monetary system. We show you what the sophisticated investors are doing. We explain what's coming next. Subscribe, enable notifications, because the gold versus dollar battle is intensifying, and the next 3 years will determine which one breaks first. The repricing is coming. Be ready.